with the markets pricing in a rate hike in July. What is the smart play for your portfolio? Our next guest says based on past cycles, now may be a good time to take your cash off the sidelines. Here to explain is Kristen Bitterly, who is the Citi Global Wealth Head of North American Investments. Okay, so if you're taking cash off the sidelines, where should you think about perhaps putting that into play?
So there's a number of different areas that we like and how we've been balancing our portfolios. I would say that the name of the game has actually been diversification. So we started this year thinking that we were going to see an earnings contraction, thinking that we were going to see a recession. I think the resiliency of the labor market surprised us. I think it surprised a lot of people. But in terms of how we've been positioned, we've actually been quite balanced, quite diversified. And if you look at some of the statistics out there, the 60-40 portfolio is up over 10% year to date. And so if you are someone who's been sitting in cash on the sidelines, maybe you've earned around 2% year to date. Whereas if you had a diversified portfolio, you're in the double digits. And so from a strategy perspective, one of the ideas that we like in these summer months is we do think that we are hitting peak rates and take advantage of extending duration within your fixed income portfolio to lock in those rates for a longer period of time. You don't have to be hanging out just in 6-month T-bills. You have that ability to now lock in rates for 5-7 years and create that income stream for a longer period of time. So that's one, not increasing risk too much, but at least being able to take advantage of the rate environment that we're in.
I mean, it's interesting right now, too, because in the past several weeks, or really in the last week, we've seen some higher forecasts for the S&P 500 start to come out. And our morning brief today by our Miles Udlin looked at the bottom-up forecast for the S&P, too, which I think are around, 4,800 or something. So there is, despite maybe a rolling recession in your scenario, is there still the prospect that we could see stocks perform pretty darn well this year?
I think this is we talk about this in terms of market timing. I think this is actually, when you look at investor positioning and you look at all of that cash on the sidelines, in terms of downside risk to upside, I mean, on a relative basis, there is going to be a moment, and we've seen that over the summer months, right? We've seen more flows come into equities, particularly starting in May. I think the question becomes, are you putting money into those mega cap stocks that really dominated the first half of the year, or will we see some breadth and some expansion? So an area that we like is expanding into small and mid cap. We started doing that really in May, June of this year. And the reason for that is that they're trading at a 20% discount to large and mega cap stocks. And a lot of the themes that have been the salient themes about whether it's investing in digitization, investing in AI, investing in robotics, the clean energy transition, a lot of those themes exist within small and mid cap as well. So that's an area where we're comfortable adding exposure in portfolios.
I mean, it's been such a handful of tech stocks that have really driven the majority of some of the gains, specifically within that sector, but more broadly carried the rest of the S&P 500 index too. So all that considered, are the rest of those names set to also kind of see some type of comeback or some type of interest from investors? Or is that still just, all right, you haven't said AI loud enough, and so we can't have any viable reason as to why our portfolios would reflect that?
I go back to two key themes, I think, from an equity perspective. One, the free cash flow generation. And, at first, when we saw a lot of the capital coming into those names, even before Q1 earnings and the whole AI buzz, when you saw a lot of that capital come into those names, there was a thought around that it was a flight to quality because rates were coming down at that moment in time. And, you could kind of look at like tech and the inverse relationship there. But I think ultimately there is some truth to that in terms of the flight to quality in those companies that can actually self-fund their future growth. And so I think you continue to have those companies as part of a portfolio, but then looking beyond that, earnings matter. They do matter. And so you look at free cash flow generation, but the earnings story, whether it's Q2 earnings or that forward guidance that we were talking about for the second half of this year, it's going to be critically important in terms of delineating between winners and losers this earnings season.